Let us begin by clearing a dangerous misunderstanding that dominates most conversations around gold. People assume gold is always liquid, always safe, always tradable. That assumption is only true in calm markets. In stressed markets, liquidity is not guaranteed by price, by demand, or even by reputation. Liquidity exists only when buyers, sellers, settlement systems, and credit lines all function simultaneously. When even one of these breaks, the market does not slowly adjust. It freezes. And that is exactly what a liquidity trap looks like. The $47 billion figure being discussed is not about gold vanishing or gold losing value. It refers to gold that technically exists on balance sheets, but cannot be easily settled, delivered, or converted into cash without severe price impact. This is a structural problem, not a speculative one. The trap forms when paper gold claims grow far faster than the physical market that must ultimately support them. Over the last decade, gold trading has increasingly moved into derivatives, futures contracts, unallocated accounts, and synthetic exposure. These instruments are efficient in normal times because they allow massive volume with minimal physical movement. But efficiency comes at a cost. The same ounce of gold can be promised to multiple counterparties. As long as most participants settle in cash and do not demand delivery, the system appears stable. The moment confidence shifts, the illusion disappears. What we are seeing now is a convergence of stress points. Trading volumes are falling sharply while open interest remains high. This is not healthy. Falling volume means fewer participants are willing to transact at current prices. High open interest means many positions still exist that will eventually require settlement. That mismatch is the core of the liquidity problem. When positions need to be closed but the market lacks depth, prices do not move smoothly, they gap. Liquidity traps are especially dangerous because they are invisible until they are unavoidable. On the surface, prices may remain stable or even rise. That misleads retail traders into thinking conditions are safe. But beneath the surface, bid-ask spreads widen, margin requirements increase, and counterparties quietly reduce exposure. The market becomes brittle. One shock then causes disproportionate damage. The $47 billion number reflects gold exposure that is effectively locked due to reduced market participation, higher collateral demands, and settlement bottlenecks. Banks and clearing members become defensive in such environments. They protect their own balance sheets first. When that happens, liquidity is withdrawn precisely when it is most needed. This is why warnings like "do not trade" are not exaggerations. In a liquidity trap, correct direction does not guarantee profit. You can be right on price and still lose money because you cannot exit at a fair level. Slippage becomes extreme. Stop losses fail. Margin calls trigger at the worst possible moment. These are mechanical failures, not analytical mistakes. Another critical element is timing. Liquidity stress does not unfold evenly. It builds quietly and then accelerates suddenly around known calendar pressures. Contract expiries, quarter-end balance sheet reporting, regulatory capital checks, and seasonal demand shifts all act as catalysts. When these align, markets experience forced behavior rather than voluntary trading. Gold markets are particularly vulnerable because they sit at the intersection of commodities, currencies, and financial hedging. When interest rates remain elevated, the cost of holding leveraged gold positions rises. That discourages new buyers and pressures existing holders. At the same time, physical demand does not instantly absorb excess paper supply. This creates a void where sellers exist but buyers hesitate. What makes this phase especially dangerous is the false sense of safety created by historical narratives. Gold is remembered as a crisis hedge. That memory causes traders to ignore current structure, but markets are not defined by history. They are defined by plumbing. And the plumbing right now is strained. Liquidity traps also feed on psychology. When traders sense that exits may not be available later, they rush to exit early. That behavior reduces liquidity even further. It becomes self-reinforcing. Volume dries up, volatility spikes, and confidence collapses. This is not panic selling. It is rational self-preservation under structural stress. The reason professionals become cautious before visible crashes is because they monitor these internal signals rather than price headlines. Declining volume, frozen contracts, delayed settlements, and rising collateral haircuts are early warnings. Retail participants rarely see these directly. They only experience the consequences when it is too late. This is why a liquidity trap is not about predicting direction. It is about recognizing when the market mechanism itself is compromised. In such conditions, patience outperforms activity. Capital preservation becomes more important than opportunity capture. The gold market today is not screaming danger through price collapse. It is whispering danger through silence. Low volume, hesitant participation, and locked capital are the financial equivalent of a fault line under pressure. Nothing appears wrong until it suddenly is. In the next part, we will examine how paper gold dominance created this vulnerability and why physical delivery stress is the real pressure point behind the $47 billion figure. To understand why the gold market is now facing a liquidity trap, We need to examine how gold trading gradually drifted away from physical reality. This did not happen overnight, and it was not accidental. It was the natural outcome of a financial system that prioritizes speed, leverage, and efficiency over resilience. Gold was once traded primarily as a physical asset. Ownership meant custody. Settlement meant delivery. Risk was transparent because limits were imposed by how much metal actually existed and could be moved. Over time, this constraint was seen as a problem rather than a safeguard. Financial innovation promised to solve it. Paper gold instruments were introduced to make gold more accessible and liquid. Futures contracts allowed traders to speculate on price without touching metal. Unallocated accounts allowed banks to offer gold exposure without segregating specific bars. Exchange-traded products allowed investors to gain exposure with a single click. Each layer reduced friction. Each layer also diluted the link between price and physical supply. Individually, none of these instruments are inherently dangerous. The danger arises when they become dominant. Today, the vast majority of gold trading volume is paper-based. Physical gold rarely moves, while claims on gold trade continuously. This creates a fragile structure where confidence, not metal, becomes the foundation. The system works as long as most participants agree to settle in cash rather than delivery. But this agreement is implicit, not contractual. In periods of stress, incentives change. And when trust in currencies weakens, when geopolitical risk rises, or when counterparty risk becomes a concern, the desire for physical settlement increases. That is when the system is tested. The problem is that paper gold markets were never designed to handle widespread delivery demands. The underlying physical market is too small relative to outstanding claims. Even a modest shift in behavior can overwhelm it. When that happens, the response is not immediate default. It is rationing. Rationing takes many forms. Delivery delays become normalized. Premiums between physical and paper prices widen. Minimum delivery sizes increase. Settlement terms quietly change. None of these trigger headlines, but all of them signal stress. The market begins to distinguish between gold in theory and gold in hand. The $47 billion figure represents exposure trapped in this transition phase. It is gold that exists in accounting terms, but is functionally illiquid because converting it into physical metal or even into cash without loss has become difficult. The market has not failed yet. It is constricting. A key driver of this constriction is the role of clearinghouses and bullion banks. These institutions act as intermediaries between buyers and sellers. In stable times, they smooth transactions. In unstable times, they protect themselves. When volatility rises and liquidity falls, they increase margin requirements and reduce balance sheet exposure. This is rational behavior, but it has systemic consequences. Higher margin requirements force traders to post more capital to maintain positions. Those who cannot are forced to exit, but exiting requires liquidity. When many participants attempt to reduce exposure simultaneously, the lack of buyers becomes apparent. Prices gap, not because fundamentals changed, but because the market cannot absorb the flow. This is where the liquidity trap tightens. Positions that look profitable on paper become impossible to unwind at reasonable prices. Traders hesitate, hoping conditions improve. That hesitation further reduces volume. The trap is psychological as much as mechanical. Another overlooked factor is the role of arbitrage. In theory, discrepancies between paper and physical markets should be corrected by arbitrageurs. In practice, arbitrage requires balance sheet capacity, credit lines, and operational flexibility. When stress rises, these resources are constrained. Arbitrage stops functioning. Dislocations persist. This breakdown is particularly visible when futures prices diverge from spot prices or when regional premiums spike. These are not anomalies. They are symptoms of a market losing coherence. When price signals fragment, confidence erodes further. The illusion of liquidity is maintained by screens and charts. Prices update every second. Trades appear to occur. But liquidity is not about frequency of price updates. It is about the ability to transact size without disruption. That ability is diminishing. What makes this situation dangerous for retail traders is that paper gold markets give the impression of depth. Order books look full until they are tested. When stress hits, bids disappear faster than they appeared. Algorithms withdraw. Market makers widen spreads. What remains is a thin, volatile environment where small trades move prices disproportionately. The $47 billion trapped exposure is not a single event. It is an accumulation of positions that assumed normal market functioning would continue. Those assumptions are now being questioned. When assumptions change, markets reprice risk abruptly. This is why warnings emerge before crashes rather than after. Professionals understand that liquidity disappears before price collapses. By the time prices move dramatically, exits are already closed. The paper gold system was built for efficiency, not stress. It maximizes turnover in calm conditions and minimizes resilience in turbulent ones. That trade-off is now being revealed. In the next part, we will explore how declining volume, frozen contracts, and calendar pressures combine to turn this structural vulnerability into an immediate market risk. Markets rarely collapse because of bad news alone. They collapse when participation disappears. Price is only the surface expression of a much deeper process. Volume is where the truth lives. And right now, volume in the gold market is sending a warning that is easy to ignore and costly to dismiss. Declining volume is often misunderstood. Many traders assume that lower volume simply means consolidation or lack of interest. In reality, context matters. When volume falls during periods of rising uncertainty, it does not signal calm. It signals hesitation. Participants are stepping back not because they see no opportunity, but because they see risk they cannot price. In the current environment, gold trading volume has dropped sharply while open interest remains elevated. This combination is structurally dangerous. Open interest represents outstanding obligations. Volume represents the ability to change or exit those obligations. When the second shrinks and the first stays high, pressure builds. Frozen contracts are the clearest manifestation of this pressure. When contracts are frozen or effectively untradeable, it means the market is no longer clearing efficiently. This does not always appear as an official halt. Often it shows up as extreme slippage, delayed settlement, or sudden changes in contract terms. Traders discover the freeze only when they attempt to act. The presence of tens of thousands of frozen or inactive contracts suggests that positions exist without corresponding liquidity. These positions cannot be easily transferred or closed. They sit in limbo, contributing to the $47 billion trapped exposure. Each frozen contract is a small fracture. Together, they form a fault line. This situation is intensified by the behavior of institutional participants. Large funds and banks do not exit markets impulsively. They reduce exposure gradually, often through internal adjustments that are invisible to the public. They shorten holding periods, reduce position sizes, and tighten risk limits. This slow withdrawal drains liquidity without triggering alarms. Retail traders, by contrast, often increase activity during uncertain periods, believing volatility creates opportunity. But retail activity cannot replace institutional liquidity. It adds noise without depth. When professionals step back, markets become hollow. Another factor is the role of calendar events. Futures markets are structured around expiration cycles. As contracts approach expiry, positions must be rolled or settled. In normal conditions, this process is smooth. In stressed conditions, it becomes a bottleneck. When many participants attempt to roll positions in a low-volume environment, liquidity is strained further. Quarter-end reporting adds another layer of pressure. Banks and funds adjust balance sheets to meet regulatory and internal targets. Risk assets are reduced. Capital is conserved. This behavior is not coordinated, but its effects are cumulative. Liquidity is withdrawn at the same time across the system. The result is a market that appears calm but is internally rigid. Small shocks cause outsized reactions. A minor price move triggers margin calls. Margin calls force selling. Selling finds no buyers. Prices gap. Confidence breaks. The sequence is mechanical, not emotional. What makes this particularly dangerous is the delayed recognition. Traders look at charts and see stability. They assume stability implies safety. But stability in low-volume environments is deceptive. It often precedes volatility, not prevents it. Frozen contracts also introduce counterparty risk. When settlement is delayed or uncertain, trust between participants erodes. Each trader begins to consider not just market risk, but whether the other side of the trade can perform. This consideration reduces willingness to transact. Liquidity dries up further. This is how liquidity traps deepen. They are not caused by a single event. They are caused by many small decisions made independently, but in the same direction. Everyone becomes cautious at the same time. The $47 billion figure is therefore not static. It can grow rapidly if conditions deteriorate. Each additional position that becomes difficult to exit adds to the trapped exposure. The trap tightens, not because new positions are created, but because existing ones become immobilized. This is why professional risk managers focus on exit conditions rather than entry signals. They ask not whether a trade is profitable, but whether it can be unwound under stress. In the current gold market, that question has an uncomfortable answer. Liquidity is confidence in motion. When confidence stops moving, markets seize. The gold market is not seized yet, but it is stiffening. The warning signs are present for those who know where to look. In the next part, we will examine how leverage, margin pressure, and interest rates interact to accelerate liquidity breakdown, and why even correct trades can fail in such conditions. Leverage is often described as a tool, but in stressed markets, it becomes a trigger. In the gold market, leverage is embedded not just in futures contracts, but in the entire structure of trading. Margin, credit lines, and funding costs quietly determine who can stay in the market and who is forced out. When liquidity weakens, leverage does not amplify opportunity. It amplifies fragility. In normal conditions, leverage allows traders to control large positions with relatively small capital. Margins are predictable, funding costs are manageable. Price movements occur within ranges that allow risk to be adjusted gradually. But these conditions assume a functioning market. When liquidity deteriorates, those assumptions break down. Margin requirements are not fixed. They are adjusted by exchanges and clearinghouses in response to volatility and perceived risk. When liquidity falls, volatility increases. When volatility increases, margins rise. This feedback loop is mechanical and unavoidable. Traders are required to post more capital at the worst possible time. This is where many trades fail, not because the thesis was wrong, but because the trader could not maintain the position long enough to be proven right. Margin calls do not care about long-term fundamentals. They are immediate and binary. Either capital is added or the position is liquidated. Liquidation in a low liquidity environment is especially damaging. Forced selling occurs into thin order books. Prices move sharply against the seller. That movement triggers additional margin calls for others. The process cascades. Interest rates play a crucial role in this dynamic. Higher rates increase the cost of holding leveraged positions. This applies not only to direct borrowing, but to opportunity cost. Capital tied up in margin is capital that cannot earn yield elsewhere. As rates rise, tolerance for low yield or non-yielding assets declines. Gold, as a non-yielding asset, becomes more expensive to hold in leverage form. Traders who once viewed gold as a safe hedge reassess their positions. Some reduce exposure, others hedge more aggressively. Both actions reduce liquidity. This reduction is subtle. It does not appear as panic selling, it appears as absence. Bids become cautious. Market makers quote wider spreads. Depth disappears. The market still trades, but it no longer absorbs stress. The $47 billion liquidity trap is magnified by this environment. Positions that were sustainable under lower rates and stable liquidity become unstable under higher rates and reduced participation. The trap is not triggered by a single policy decision. It is activated by cumulative pressure. Another often overlooked factor is correlation. In stressed environments, assets that are usually uncorrelated begin to move together. Gold, equities, bonds, and currencies can all experience simultaneous stress as participants sell what they can, not what they want. This behavior undermines diversification strategies. When gold is sold to meet margin calls elsewhere, its price behavior becomes disconnected from its narrative as a safe haven. Traders expecting gold to rise during crises are surprised when it falls. This surprise further damages confidence. Correct trades fail in such environments because timing becomes impossible. Markets move faster than human decision-making. Algorithms dominate execution. Stops are triggered automatically. Slippage turns manageable losses into catastrophic ones. The concept of being right loses meaning when market mechanics override analysis. A trader can correctly anticipate long-term inflation, currency debasement, or geopolitical risk, and still be forced out by short-term liquidity stress. This is not unfair. It is structural. Professional traders understand this and adjust behavior accordingly. They reduce leverage before stress becomes obvious. They accept lower returns in exchange for survival. Retail traders often do the opposite. They increase leverage to compensate for uncertainty. This asymmetry explains why losses are concentrated. The gold market today is unforgiving to leverage. Margin pressures are rising. Funding conditions are tight. Liquidity is thin. These factors interact to create an environment where patience and restraint outperform conviction. This is why warnings to avoid trading are not calls to fear. They are calls to discipline. Not every market environment rewards participation. Some reward observation. The $47 billion trapped exposure represents leverage that assumed stability. As that assumption fails, the leverage becomes a liability. The trap tightens not through collapse, but through pressure. In the final part, we will bring these elements together and explain what typically happens next in liquidity traps, how they resolve, and what lessons traders should take forward without attempting to time the outcome. Liquidity traps do not resolve the way most people expect. They do not end with a dramatic announcement or a single catastrophic event. They end quietly through exhaustion, repricing, or intervention. The danger lies not in predicting which path will occur, but in assuming that time alone will restore normal conditions. Historically, liquidity traps resolve in one of three ways. Capital either exits, is forcibly removed, or is absorbed by a structural reset. None of these are gentle. Each involves loss, not necessarily of value, but of assumptions. The assumption that liquidity is permanent is always the first casualty. In the gold market, a liquidity trap typically ends with positions being unwound at unfavorable levels or converted into longer-dated exposure with different risk characteristics. Some participants accept losses to regain flexibility. Others are forced to accept new terms they did not originally agree to. A smaller group, usually with strong balance sheets, survives by doing nothing at all. The $47 billion figure will not disappear overnight. It will shrink as positions are closed, rolled, or written down. This process can take weeks or months. During that time, price behavior may appear irrational. Gold may move sideways despite strong narratives. It may fall during periods of apparent crisis. These movements are not contradictions. They are symptoms of constraint. One of the most misunderstood aspects of liquidity traps is the role of intervention. Central banks and large institutions do not intervene to protect traders. They intervene to protect systems. If intervention occurs, it is designed to restore function, not profitability. Liquidity may return, but prices may not recover in the way participants expect. Another common misconception is that volatility marks the end of a trap. In reality, volatility often marks the transition. It signals that the market is attempting to find a new equilibrium. During this phase, price movements are exaggerated and unstable. Trading this phase requires exceptional discipline and resources. Most participants are better served by staying out. What comes after a liquidity trap is rarely a return to the previous state. Markets remember stress, regulations change, margin requirements remain elevated, participants adjust behavior. The system becomes more conservative, at least temporarily. Opportunities return, but they are different from those that existed before. For traders and investors, the most important lesson is not about gold specifically. It is about structure. Assets are only as safe as the markets that trade them. Liquidity is not an attribute of an asset. It is a condition of the system. Gold will continue to exist. It will continue to play a role in portfolios. But the way it is traded is changing. Paper dominance has revealed its limits. Physical constraints matter again. This does not mean prices will surge immediately. It means the market will be more selective, more fragmented, and less forgiving. The instinct to act during uncertainty is strong. Humans are wired to seek control. But in liquidity traps, action often creates risk rather than resolves it. Waiting is not passivity. It is a position. The $47 billion liquidity trap is a reminder that markets are not just charts and narratives. They are networks of obligations, trust, and timing. When those networks strain, the safest move is often to reduce exposure and preserve optionality. Optionality is the ability to act later. It is lost when capital is locked, margins are consumed, and exits are unavailable. The participants who emerge strongest from liquidity traps are those who value optionality over prediction. This period will end. It always does. But the end will not reward everyone equally. It will reward those who respected the warning signs and avoided the illusion that every moment must be traded. Gold is not broken. The assumption of effortless liquidity is, and that distinction makes all the difference.